Thank you. Good afternoon, everyone. Mm, well, we are a little behind the schedule, so I'm gonna pass the floor to Lucas to start the Q&A session. Good afternoon, everyone. I would like to thank the Planning Committee on behalf of Dr. Luis Flavio for the invitation to be here. In this panel, we're going to speak about some of the topics addressed during the panels over the day. The first question is to Claudio Pimentel. In some moments of the debate, some criticism was made to the arm's length principle. What are the existing alternatives to this model? Thank you for the question. We recognize that the arm's length principle is complex with regard to or compared to our fixed margin principle. This is a fact. But this complexity must be regarded, it has to be seen within the international context. What we have seen is that many multinational companies like it because it is simpler, it is better for personal need and work, is simply for you to adopt something that is adherent by both countries. So suppose you have a transaction between Brazil and France adopts the OECD rules. So this complexity is not that much when you use the same system. So by which if Brazil adopts it, so the Brazilian company doesn't have to make a calculation that is totally different from the one done by its counterpart in France in this case. What we also heard is that the cost is reduced and because they simply do not have to use these two systems. You should also consider that. And the risk is even lower of having a double taxation because you have adherent systems. And then this is why this is possible. This was not possible before.
If one asks if rules more objective as before we was thinking about it, would it be possible for us? Well, adopting unilaterally is feasible, but I think it's the option Brazil would like to have. We can see about B debates that are being held in Pillar 1 regard not to be. It's a definition of percentages, margins, or how to simplify, but with the baseline, which is very specific function, and we don't reach a conclusion on regarding it. So there's divergency. Countries are heading towards, but there's a divergency. Therefore, it seems to me that a model where you have truly the vision of providing international stability, it seems to be still the model adopted by most of the countries that Brazil has joined now. Therefore, I think these would be the remarks I would like to share regarding this question. Fantastic. Now, it was a highly complete answer, so we are going to skip to the next question for Roberto. Roberto, the question sent is the following. Zora implementation is logic contrary to 108 paragraph 1st of CTM, and what are the risks of indiscriminated adoption of it and the main control parameters for its control? First, good afternoon. I would like to thank all from the coordination of this event and congratulate by the excellent organization. Directly to the question, my comment regarding Dra. Cláudia, what she shared with us, in fact, we have to adopt something that will converge to the arm's length standard. We heard some panels, previous panels, criticism regarding arm's length, especially on a digital economy landscape. In this situation, we don't have comparable for all special, especially intangible, and we talked a lot about global formularium apportion would be ideal because it would capture all synergy elements with multinational structure, but it's not feasible because many countries did not agree with the criteria of the formula. Would be a portion share profits in a formula that would consider revenues, costs in labor, tangible, intangible. So developed countries and developing countries, they would never reach an agreement. Therefore, this of course would offend more than 4,000 treaties celebrated to date. Article 9, which is incorporate the arm's length, just to re-stress the good initiative, which is the conversion to a system that clearly subjective, but it's the standard adopted by most of the countries of the world. Towards the hora, the question is remarks realistics and transaction by the end it would end in analogic taxation. We know analogy is an instrument for you to close gaps in expressly provided by tax law regarding certain situations. It's part of a coherence and arm's length of economy, I'm sorry, that is done through taxation that's not expressly dealt with should receive an equivalent treatment by the using the analogy you will reach a tax burden. I don't understand this is happening with hora. What is hora? We must understand a bit what was said regarding the panels of Professor Schwer, so well explained, Arivi also. Horas, they are a resource present on transfer pricing, alignment and recognizing the transaction and guidelines also order while pricing, especially while adopted other two-sided methods that are main profit split for those involving intangible transactions. We don't have the it lacks discipline on these transactions, but in all phases for enforcement, the four phases of transfer prices, the alignment, recognition, and method indication and pricing, we have a bit of the order surrounding this. It's a concept with a level of not being determined, as Professor Schwerin mentioned. There's a standard of rational thinking from the point of view of economic aspects. Second, it's not the term legal concept. The realistic thinking about the options available, they all have a high level of not being specific. So it's the function, although not its analogic translation is the function of those who construe it, and we taxpayers to use this instrument carefully because the risk in the guidelines, if all countries adopted this powerful tool without the due care, what would happen? It's a multiple taxation risk. Each country will characterize the transaction as they wish, so at their discretion. So it's powerful, and has to be carefully used. All auditors here careful because of the risk of double taxation. And when we think about OECD guidelines, the parameters that third parties independent would do. Test is what the parties do. This we always have to think that because it is an extremely exceptional resource must be used exceptionally. Here, OCDE advocates clearly more attractive option. It must be like this. It's not any option. Clearly more advantage. When we think about options, there, if there it's a legal determination, not talking about option. In fact, available involves at the time it was done the transaction, it was effective. So the time is important. Clearly, to be available, it cannot be unlawful or contrary to the regulation of any countries. It would be deemed as discharged, not available as an option. these are some of the parameters I would like just to advise. Take into account the comment you made that Claudia will answer, will give the opportunity for her to deal with the subject. Passing the floor to Claudia, we can move on. Thank you. I could not agree more or say better, explain better, or as you just have done. According to our view, order must be enforced very carefully. It's exceptional. Exceptional scenario situations to use it, and it aims towards guaranteeing the right use of the arm's length principle. You must compare with independent parties would do. What we think to do about regarding inland revenue to be more comfortable. I understand the concern arising from it. We are not used with norms that are so subjective. It's understandable the concern. This is a new world. What we thought about doing is placing an attachment with examples. What would be this possibility of using it? And it seems to me that perhaps with this we will have more clarity. These situations that we should use or not, because in as the anti-evasion rule for out of transfer pricing scenarios. Thank you, Claudia, Roberto. Now the next question, Leonardo will comment the following question. If the taxpayers use the SAR in the treaty, is it possible to deny benefits to taxpayer based in PPT? And if the latter not applicable, what about the domestic rules? Thank you, Lux. And this is a question that causes huge divergence in both questions. There cause divergency according to the doctrine. More than going through some steps of doctrine, what OECD talks about interaction, anti uh, shop treating, shop treating, and the rule of contracting part. OCD with the guiding principle before it had the expression main purpose evolving in 070 after BEPS for clause PPT positioning is that anti-shop treating treaties domestic clause would not conflict with double taxation agreements does not mean that there would be limited use of such rules as long as they are not conflicting with conventional clauses. So this is basically the position of OECD regarding the subject. Now, which issues we might have? Divergency of requalification contracting states. The host state vary the transaction with qualifies dividends, the other state as interest. There's a conflict of qualification. Doubt, do we enforce new approach rules of the source state would dictate the rules resident state would follow this rule. As I said, it's difficult, will lead to divergences on the doctrine. And in addition to the interaction of domestic rule with the clauses on the treaty, especially in PPT, we have the outcome of this. Overcoming the enforcement of PPT clause, the doubt is, do I still have access to the benefit of the access, or am I blocked? PPT, I'm out of the treat for all and any conventional clause. This is the subject matter of the discretionary relief that in Brazil we have a treaty with Singapore setting forth the following. If this PPT clause denies certain benefit from the treaty, it does not mean I would not have access to other benefits. Example, as for the cases acquisition of equity on a company to be beyond 25% limit on the dividends rule, and then I can have a tax rate at the source reduced. Even though I can get the tax rate reduced, that I would fall within the general limit of 15%. Those are debates that we have the consequences of anti abusive law and the PPT and the abusive law of domestic law and the PPT. So the relief is in the comments of OECD Article 7 and paragraph 4 of MLI. If I don't have a treaty with this clause, then I can deny any benefit to taxpayers foreseen by the treaty, i.e., discretionary relief is you interpret this clause, or I can think inversely. If the treaty has this clause and those that don't have do not have the discretionary relief effect, this is a problem we have that would generate two effects: double taxation, and the second, transforming the PPT clause as a punishment clause, which is not the intention according to my understanding for the contracting states by introducing. Last comment, this is based on the interaction with SARS, specific anti-abuse rules. If the taxpayer has a structure that goes through requirement of SARS approved on the first phase, could I still enforce the General Anti-Abusive Treaty clause, the PPT? This also has a diversity in the doctrine, especially the exist or antinomy amongst rules. My point of view, I could enforce PPT clause as long as ILOB taxpayer would search to contour LOB in abusive way. That in this scenario, I could, yes, go through the test of my SAR, LOB of the treaty, and later the enforcement of general clause anti abuse. And now passing the floor to Diogo. Important to say that these clauses, anti-shop treaty, we saw in the double taxation agreed to be within the scope of the treaty. The more we have definitions, anti-treaty shopping within the scope of the treaty was avoid qualification conflicts, as I mentioned, between the source of state and residents to it, and this resident will say, I will not give you the credit because you didn't enforce the treaty according to the convention. Thank you very much. Thank you, Leonardo. I would say, talking about treaty and fresh air, now we go to the transfer pricing for Mateus. My question is, during the presentation of José André that talked about the subject, it was mentioned the thin cap rules. Therefore, there's a doubt. What's the expectation for these rules before the convergence of Brazil for the model of OECD for transfer pricing? The rules of undercapitalization, do they have any space to be enforced? Thank you, Job, for the question. Good evening. And to answer very straightforward the question, expectation of thin cap rules is low, not to say none. The reason? Decision by the legislative, I think the thin cap was changed all things, especially regarding the famous and well-known concomitant enforcement. Many would go back to debate what's worth the TP, thin cap, these debates. The doctrine is documented very well since 010 and nothing new in the area. So what we unveil from the TP law, it's a finding that our Thin Cap Act more and more is getting old-fashioned, pre-BEPS Act from 010 based on the standard of 98, a harmful tax practices of 98 report, the first mean package of OECD, so did not adopt anything that we saw as a good standard, ignoring the capital structure of the company, asset structure of the company, EBITDA of the company, just knows the asset equity of the company in a proportion of 2 to 1 indebtedness and asset, imposing a limit, establishing a limit of deductibility. This is necessarily bad, not always. Might be good because it's simple, easy. No one must be an accountant to know in numbers these assets of the company multiplied by two opening, but with thin cat or not. But be bad for taxpayers. Necessarily involves some leverage in indebtedness and low interest times, and I, capital cost is very low. So in this aspect, it seems not proportional as anti-shop treated. So with regard the taxpayer in that sector, it seems disproportional. And on the TP side, it's a rule sophisticated. All recall not the good old times of LIBOR plus 3 when the control of interest was controlled by a law, specific law. Then we adopted interest rates that Brazil has its negotiable instruments with. It was before prefix is LIBOR plus 6 months. It's spread established by the Ministry of Treasury. No longer this exists now. We don't have interest rate by TP. It's by the market standard with arm's length. And guess what? Take into account the options available. I will not talk about this. Bear to mention other friends. I like to say this option available why might take the interpreter believe what was in that transaction was not truly indebtedness but capitalization. So TP law today authorizes to deal debt as capital. And notice this in the scope of our Thin Cap Act. At a certain point, it's useful for this. So we find the system today had two norms equally anti-treaty shopping, similar with the same target. One very simple, but tending to lack of proportionality, and the other highly complex, but it's not disproportional because comparability requirement the transaction has to be adjusted to mine. This is the dilemma, this choice to be made in terms of the legislative design for a future reform of our legislation on income. So, thin cap rule is bad, although easy or updating the thin cap rule.
And this is the practice that continues to be improved by the Brazilian legislation and about this matter. Thank you, Mateus. Now let's proceed with uh, transfer pricing. Carolina, comment on that companies have a mandatory are required to submit a master file, and all the transactions are operated with tax haven countries. This is a matter that is very simple because the master file basically brings all information about the multinational group. If you do not have a multinational group, there is no information that will be necessary for you to fill out the master file, unless you do that, you just use it that is not applicable for many issues. Because there are penalties that are very high cost if you do not deliver all the files, local and global files. So there are penalties applied to them. So of course, taxpayers have to deliver all of that filled out. But the file will be very incomplete if you do not have a multinational group. Then it doesn't make sense that you prepare this master file for one that is not multinational company. There are lots of doubts about this from taxpayers. And some of the questions that have been raised by taxpayers is about small operations that are not required to be applied to the files. And then, of course, we in the previous legislation we had the safe harbors that could be used for this type of operations. So many taxpayers did not have the control based on this characteristic of the safe harbor. But now under the new legislation, this is not really established. So this is why many taxpayers have been asking whether these small operations, they really have to have a benchmarking study, which is expensive, and submit all the documentation. So of course, we are still expecting to have something that will establish the guidelines for this. But basically, this is it. So, if you have any other comments to make, Claudia? With regard to tax haven, there is a concern to see whether the company established there is really a non-related party. Because sometimes they say it's not to be related, but actually they are. So if the company is really non-related, then it seems to me that this is a problem because then they will not have this piece of information. And there are some rules under the legislation that will lead us to consider simplifying all of this and then just show the company that they are not a related party to that. Now we go to another topic related to Pillar 2. So all the following questions will be related to Pillar 2. This is to Belisa. In case the Pillar 2 guidelines are adopted in Brazil, the tax regime based on universal laws of law 12973 will have to be adjusted. And can we still consider this as a CFC? Thank you, Diogo. I think that this is a question that automatically Brazilians ask when we think about Pillar 2. Of course, Pillar 2 has a purpose that is not exactly the same one of our TBU rules, but eventually it is possible that they overlap. And then earnings of controlled and associated companies located abroad can be submitted under both rules in case Brazil adopts the Pillar 2 rules and continue with the TBU rules effective as they are now. The TBU rules are really broader than the Pillar 2 rules, as Claudia has already said during the panel. Not only so, because TBU rules make earnings by associated companies and controlled companies to be submitted to a 25% tax rate, differently from Pillar 2. And the TBA rules are different from the calculation methods used in Pillar 2. So this is why we can have a double application of this rule, because it may be the TBA rule is a little bit broader than Pillar 2 rule, but in some cases it may be that it does not really capture what Pillar 2 rule will capture. So we may have an overlap of rules, but at the same time they can complement each other. But the issue here that I would like to stress is that we do want that. Do we want two regimes that are extremely complex and they complement each other? Because even though the objectives are not the same, they can reach the same results. So the question that I would like to put here to the IRS and everyone is that, do we want to have these two rules? Because Pillar 2 and adopting Pillar 2 would just raise another opportunity to Brazil to review and adjust its TBU rules, and also to adopt a rule that is more similar to the CFC rule just adopted by other countries. So I think that this is an opportunity for Brazil to adjust and just step back and then align its rules according to the international standards with regard to CFC rules. And also because non-alignment will create a system that is more complex and more accessory obligations or collateral obligations. It may be that we have to calculate both, to have calculations made under these two rules. And under the globe rules, tax paid are done under the CFC rule. So when we have the double IR, the tax is calculated based on the CFC rule, and then they are going to consider this tax from the subsidiary company, which is under the CFC rule. But for them to do that, they have to consider that the rule is one of CFC, and we know the Brazilian rule is being debated to see whether the TBU rule here is really a CFC rule. So of course this can also cause a debate in the sense that the country that's going to apply the double RR is really considering this as being a tax paid in Brazil because of the CFC rules, and this can also lead to a double taxation and also generate some conflicts with some other countries. Then Brazil will have to justify these rules so that the double taxation is not really happening. So I think that there is a need for Brazil to adopt Pillar 2, and I would like to have these TBA rules reviewed. Now, to close the day, because we have had very in-depth debates, now we have two people to answer the question, Audrey and Leonardo Aguirre. They will speak about the tax benefits seen under Pillar 2 context. Before we just go into this topic, I think that we have to think, what do we want to be as a country? I recall that on some occasions we had global presentations, like at Singapore. So, how did they start their rhetoric? They started by saying, what do I want to be as a country? And then they said, I want to be a hub to Asia Pacific. And then they described the rules and the tax benefits that they had. So for every rule and tax benefit was focused on what they wanted to be as a country. I would like you to hear, but it's okay. So I believe that, this connects with RRS in the following way. Considering Pillar 2 rules, there will be situations in which tax benefits given in Brazil consider the tax rate a denominator or numerator, and the effect will be different. So for it to be a qualified refundable tax, there are some requirements to fulfill. So above all, we have to think, what do we want to be as a country? I'm just going to give you an example out of the blue. Let's say a teaching education institution. There are some of them that are benefited very relevantly by a country. So if I adapt this rule for it to be a qualified refundable tax credit entity, so I am going to foster this activity that I would like to have fostered in a country. So I think that we have to think, what are the benefits we have? There are some that will be maintained because we have exclusions of employees or exclusions of tangible assets. And these can be, for example, an activity that have many tangible assets may not be affected, but there are some other activities that will be. So again, I think that this is the moment for us to look at the benefits that we have and then see which ones have to be maintained according to what we want as a country. And some of them will have to be rearranged or adjusted so that they can be qualified under Pillar 2 rules. And then with this, we can maintain the incentives that will be relevant to our country. Thank you, Audrey. Good evening, everyone. To wrap up, and Claudia has to leave, but anyway, if you have to leave, just feel free to do so. I have a brief comment about credit. Pillar 2 has been inviting us to review our tax benefits. Just say farewell to Claudia. Thank you very much for being here. I'm sorry for interrupting you. I think it's okay, no problem. This is just a debate. So Pillar 2 invites us to review the tax incentive or benefits. There are several of them, provided they can be enjoyed by all the companies under the scope. So pairs that have been mentioned by Claudia earlier, P&D, PAT, well, PAT, there are several of them. Then once Brazil apply Pillar 2, they will lose effect. They will be ineffective. Sorry. In their recommendations of OECD, they want this format to be changed. So instead of not taxing, you tax and then you deliver a qualified credit, which will be something to reduce the ITR calculation. So in that year in which you pay the less tax below 15%, then you deduct from there the credits that you received in the numerator. We will have to put this on the blackboard. So when you receive the credit, this will impact how much tax you have to pay or your tax burden. This is important because the definition of a qualified refundable tax credit is one that can be very defective. One defect is that you can only have a qualified credit if it is paid within 40 years. And in the Brazilian tradition is not to have that term because we know that the subvention law, as was said, is aligned with Pillar 2. Credit must be paid in within 2 years. But routine situations may happen. Suppose that you have a lawsuit that usually takes 6 years to be judged. So the definition of qualified tax credit is 4 years. There are some other situations that can also lead to a loophole in the legislation. And now I would like to invite you to Gustavo Veratoli, because we have a very good meeting to discuss this topic. And they show in their calculation, showing all the situations in which this definition of refundable tax credit is really defective. And it has to be adjusted to our reality. The law of subvention law has already posed this landscape. It has been just added, but we don't have that pillar 2 reflected in it. But of course, we're going to face difficult moments if this is not standardized in order to protect companies that will be subject to that regime. Because in the end of the day, if this protection is non-existent, we're going to have a more top-up tax, and then at the same time you'll be out of the domestic regime that will give you credit. So you are penalized in two ways. So we have to address this issue considering these two major aspects, especially the time of 4 year or the 4 year period. Well, our time is up. I would like to thank everyone and all the assistants or the attendees, sorry. I hope to see you tomorrow for the last day of the Congress. Thank you very much. Good evening.